New extreme is most likely going to be formed and price created new high, and this high is higher than the high inside of this channel. So the trend line rule was fulfilled. After that, price created a shortened downtrend, which also had a break, moved to a new extreme, and then price indicated a correction phase. So after you have a break in new extreme and you have a reversal pattern, you can start looking for shorts. But once this downtrend played out, because this was just a shortened pattern, the correction phase for this overall initial uptrend came into play. So this is how you follow the trendline rule. When price breaks the trend line, don't start counter trend trading just yet. Expect continuation of the previous trend. Counter trend trading while trend line is in play is against the price action rules, and most of the time you will get burned. After correction, trend can resume or reverse, meaning after there's a break of a channel, new extreme form, and there's a correction phase. If the bias is strong enough, there can be a larger pattern and trend may resume, or after that correction, the new trend may start in the opposite direction. The trend may reverse. We have a nicely fitting uptrend working higher, multiple confirmation indicating to me that this channel is valid. So I'm following the trendline rule. I'm only focusing on long opportunities. I'm not looking for shorts, even when I have a break of this channel. Just because we have a break of this channel, that doesn't indicate reversal. That's against the trendline rule and that's against the price action rule. I expect for price to create new high. Price created new high, formed a double top, which is close enough to be considered as new high. And after that, price slowly consolidated and there was eventually downtrend after that. But only after you get a break in new high, the trendline rule is fulfilled, and then you can start acting accordingly. Bearish downtrend working lower, beautifully fitting channel. This is why market geometry is a real thing, and this is how you can understand that the structure is bearish. You don't need any indicator. All you can need is the simple naked chart, naked candlesticks, and you can get the understanding what the price is going to do. Price close outside of this channel indicated break. This is not the time to buy the market just yet. Price created big move to a new low, to a new extreme, and from this point on, traders are safe to at least play with the idea of possibly buying the market and eventually going long. With trendline rule correlates the second price action rule that says don't counter trend trade. A lot of beginner traders, when they're watching the strong trend go, they feel that the trend cannot go any further and they will start to pick tops and bottoms, and this a lot of times lead to never-ending frustration and to a lot of multiple losing streaks. Doesn't matter how good the signal bar looks, how good the setup looks, if the trend is in play under any circumstances, you cannot counter trend trade just yet. You will use the trend line rule to identify the trend, to follow the trend, and if you cannot find the perfect trend line, you will still follow the overall bias. Only when you get a trend in proven opposite direction, that's when you can start looking for entries in that trend. But under any circumstances, you cannot pick tops, cannot pick bottoms, and you cannot counter trend. Probabilities are just not in your favor, and most traders are losing their money trying to pick tops and bottoms. Markets are designed to make counter trend entries look favorable, and they are designed to make with trend pullbacks to look sketchy. For that reason, a lot of traders are attempting to buy the bottom in strong downtrends, but most reversal attempts in trends will fail. These rallies to the upside are just reversal attempts, and most of them will fail. They are against the overall trend. When you are not sure if the trend ended or not, you follow the overall bias, and even if you are struggling to find the proper trend line, you are sticking with the overall bias and you are not counter trend trading. Don't sell the uptrend even if long traps occur. Sometimes there can be a good long setup, good buying opportunity in a bullish structure, in a bullish trend. Behavior may be wrong, the trade may be a little bit of a congested, which is another rule we're going to talk about. There may be a short-term trend line that is in play that needs to play out. Remember the trend line rule. It goes even for the short-term trends as well. You cannot sell the long trap even if you are confident that the buyers are trapped, because the trend is still in play and you're still going against the trend and odds are not in your side. You just let these long traps play out and you're still sticking with the trend. You're still following the trend. Trend is your friend. This saying has been around for a long time. There's a reason why. And this rule goes for shortened channels as well. Even if there's a small channel and the structure is not as big, because right now I have an example of quite a strong bullish uptrend. Even if the uptrend is minimal, you still don't want to counter trend trade unless you have a break of a trend line and new extreme formed. This one is a big one, the trading range rule. The most important thing to understand about trading range rule is that most breakouts of trading ranges will fail, but we see it all on the internet. Beginner traders are trading breakouts. Majority of traders are trying to trade breakouts and they keep losing money because most breakouts of trading ranges will fail, at least temporarily. There can be a pullback and the breakout may succeed eventually, but if you are trading the breakout, you want to take it on the breakout pullback setup. You don't want to trade the breakout in its breakout phase because most breakouts of trading ranges will pull back into trading range and the breakout will fail. These breakouts are working just enough to keep the majority of traders trying, but in the long term, this is not the proven strategy to approach the market and it's against price action rule. Now, when we are watching trading range, we're observing the health of a trading range. We want to see if there is a bullish imbalance or bearish imbalance. Now, trading range rule also says not only most breakouts will fail, but we want to buy low and we want to sell high. You want to do the opposite what the common sense is telling you. Congestion is just a small pattern of a trading range and you want to avoid trading these congestion.